and welcome to DigFin VOX, Voices in Digital Finance. I'm your host, Jame DiBiasio. If you enjoy the program, give us a like, share, subscribe. My guest today is Chetan Karkhanis, Senior Vice President at Franklin Templeton. Chetan is responsible for strategic investments. I spoke with him about how the firm sees startups and technologies and platforms that they can partner with and invest in across the gamut of data, AI, blockchain, and what that means for asset managers. Chetan Karkhanis, welcome to DigFin VOX.
Glad to be here.
So I'm looking forward to this conversation because you are head of strategic ventures for Asia Pacific at Franklin Templeton. You are running around the entire region looking for ways to, augment, enhance, improve what Franklin Templeton does in the asset management world through partnerships, digital acquisitions, or investments. So I would there's a huge amount of territory to cover there. So why don't we just dive in? Big picture, to what extent is the rise of fintech and digital technologies changing asset management? Is it changing just operations? Is it just changing distribution, or is it actually having any impact on the way you think about product and the way that you relate to your clients, whether institutional or retail?
Well, thank you, James. That's a great way to start the discussion, and it is a broad nature of a question, but I'll try to break it down into some topics. I mean, certainly, off the bat, fintech or technology in general is having wide-ranging impact across the asset and wealth management space, across distribution, across the investment management functions, as well as the middle and back office and operational layer of the ecosystem. But when you break it down into what are the key themes or trends that I think really matter, in the last 10 years or 15 years or so, you've obviously seen a number of different technologies come to fruition. Cloud-based, SaaS-based technologies, the advent of data analytics and faster computing, the rise of AI, which is not entirely new, but has been sort of accelerating the past few years, and basically the digitization of basic services and functions across the ecosystem. So I think if you try to break it down into few different verticals of interest. One would be the traditional Web 2 layer. It would be the continued digitalization of common financial services, which in Asia in particular, in many ways, we're still in sort of version 1 or 2 of that evolution, just getting investors easy access to wealth, to advice, to products, and being able to transact more effectively. So I do think their asset managers need to pay attention to what's happening with not just robo-advisors and digital wealth platforms, but any sort of embedded finance plays that are really making it easier and inclusive of more types of consumers coming into the picture. And I think we have to be patient in terms of how this is evolving because, many times folks want to see a quick return on investment or, expect to see assets just pile up very quickly, but it's going to take time. It might even take a couple of generations. But I do think given the trends in demographics and how the new digitally savvy generations are embracing entirely digital only sort of interaction, I think there's still a lot of runway and room to run on the Web 2 side of things.
Yeah. Let me, Chetan, before we get into the next phase, because I know that
Yeah.
if you talk about Web 2, you were naturally implying there's also going to be a Web 3 component to that. But before we get there, let's just stay in this world for a short while. You guys have taken stakes in a number of Asia-based, whether you call it robo-advisors or wealth techs, Quantafeed, Coherent, and Dawis, the late great Bamboo, Picture Wealth. Talk to me through about what has been the learning here and how do you see the relationship between these fintechs versus traditional asset managers and manufacturers?
Right. So I think carrying on the points I was making on the digitalization of financial services, a number of these investments we've made have been largely B2B, business to business type of wealth techs, where combining the tech-enabled solution with the core investment process is how we're thinking about where the direction of the industry is going. You take, for example, one of the products we have, the goal optimization engine. What that really represents is the embedded tech-enabled chip, if you will, to drive personalization. So rather than having a mutual fund product, which is a standard wrapped vehicle, you instead have something that's much more personalized, but really driven by SaaS-based technologies, by algorithms, and by AI and reinforced learning. So what we want to see is a convergence of tech into the core investment proposition. And I think that's what we're seeing with these learnings. So at a more basic level as well, the digitalization of advice is embedded or is really manifesting itself when you look at some of our investments we've done in Quantafeed, which, by the way, powers the DBS DigiPortfolio service, Pitcher Wealth, which is providing advisors in Australia a much more digitized experience when they're dealing with clients, when they're dealing with creating statements of advice and creating propositions for their clients. So I think that's why we made the bet is, we do believe technology is going to play a bigger role in how advisors and end clients are going to interact with their financial plans. I should mention also that when you look at the recent deal we've done with InvestNet, that's an example of where and that's a U.S. company. That's an example where what we seek to do is layer on personalized, separate managed accounts or direct indexing into a platform that has been in its legacy been serving advisors. So I think it's another way of how we're seeing platforms as a way to interact more effectively with advisors, and so that they can serve their clients better with technology.
How much of this do you see as something where you just want to understand it and maybe have a horse in the race, but it's not going to be part of Franklin Templeton? And how much of this do you see will become something that you learn how to do it yourself and you decide that you want to integrate this into Franklin Templeton's own business?
That's an intriguing question. I think for the time being, we have taken these strategic stakes, and we certainly are strategic investors, not financial investors. So once we do make a stake, we make an investment in the company, we do partner closely with on the commercial side and try to drive the synergies between us and the fintech. There are certain examples of where we've taken 100% ownership of companies, such as Advisor Engine in the US. But by and large, we tend to stick to minority stakes where we can not only learn. I would think I would say it's more proactive than just making a passive bet and seeing where it turns out. But it's really about co-driving new product innovation and finding new opportunities to distribute our products and investment IP on these platforms.
There was when DigFin started about 7 years ago, there was still a lot of hype in Asia, at least, about disruption, as opposed to slotting in to support an existing status quo, but just doing it better. What do you see from the point of being from perspective of a large incumbent asset management, global asset manager? How much of this is disruptive? How much of it can you co-opt or partner with? Is there still that edge of disruption taking place in the industry that would keep a big firm like Franklin Templeton on its toes? Or are you really seeing everybody in this kind of B2B, I want to partner with the incumbents and not try to uproot them?
I think it's a bit of both. I mean, we certainly are on our toes in terms of being vigilant about what technology will impact what aspects of the business. And so have our traditional intermediary partners like the banks, the insurers, the advisory groups. But where we're trying to be cognizant of, and I know we're not getting to Web3 yet or AI, but even in the Web2 world with the traditional the non-traditional players in the space, we're keeping an eye on which players are going to be disruptive to the incumbents and which players can be complementary to the incumbents in terms of B2B wealth tech. So I think it's not a one or the other type of decision at this stage. There are going to be certain winners. You're right, James. About 7 or 8 years ago, there was a lot of buzz around, for example, D2C and B2B wealth tech. That buzz with the Web 2.0 space has matured a bit.
Right.
Now it's about consolidation and scale. And but where we hope to see going forward is that the lessons learned from those early inroads made by the pioneers are being sort of absorbed by the incumbents if they choose to sort of embark on those technologies, and they are. But also the independent ones, the independent disruptors, they're now focused on scale and achieving some sort of operating model that makes sense in the longer term, which I think the ones that exist today are doing so. So for us as an asset manager, we need to be relevant to many different types of intermediaries here, and it's just about picking and choosing where we want to partner with and where we want to be continue to play our standard role as an asset manager with a wide array of investment expertise and options.
One last question on this Web 2 side before we get into some of the cutting edge side. You also had a stake in Bamboo, which went under. What takeaways do you get from when an investment doesn't work out? How much of that is it just you're just placing a lot of bets and some work and some don't, or is there something you can internalize from that?
I think it's the nature of the business of making these forward-looking and taking some risk in terms of what bets we can take and hope to capitalize on. Uh, not to necessarily speak on one company, but the learnings we certainly apply towards our future investments and prospects that we look at. We've got a pretty active help pipeline of deals. The only thing I would say there is, even when you fail, you also succeed because you know what else to avoid going forward. And I think those bets at a holistic company level aren't taken as necessarily failures. They're taken as learning lessons for us to capitalize on.
But what does it tell you about the state of wealth tech right now, or at least in this region? So what is working, and and why is what I'm trying to get to from that.
Yeah, I think what's working is there has to be a couple of learnings from this region. Is one, pay attention to your costs and where you're trying to operate out of. Asia can be very expensive in certain parts. It can be very affordable and cheap in other parts. So learning how, if you're a startup, you got to learn about where to really invest your dollars in terms of tech, R&D, support count, headcount, and where you're trying to build your business. And I think stretching too thin may not, in terms of geographical reach, may not necessarily be the best strategy. So that's certainly one learning for all startups is, have a key focus area and try to, win certain markets before you try to expand too aggressively out of those markets. For us as an asset manager, I think the basic lesson is things aren't easy. It's not going to be that simple where you partner up and hope that an implementation with a fintech is going to lead to some immediate rewards. It takes time, it takes patience, and I would say it also takes active, proactive engagement by the management team to build out those products. So if you don't have that from the start, that's going to be a challenge.
So let's move on to what you're doing in other parts of the fintech world. I was talking about disruption versus co-option or partnership. And when it comes to crypto or anything around the tokenization story, we see this influx. Obviously, this is an area that has been very disruptive in its ethos and its impact. At the same time, starting in January this year, Franklin Templeton, among other firms, launched the first ETFs for spot Bitcoin and now Ethereum. So we're seeing, I don't know if that's a partnership or it sounds more like a co-option to me of this by traditional asset managers. What is your take on where you see the intersection between the inherent disruptive nature of peer-to-peer, trustless kind of technology and capabilities versus what a legacy player with a big brand and a history can do in this space?
Look, I think, decentralized ledgers and the inherent nature of blockchain is such that there are scale advantages, there are cost advantages, and there are ways to enhance upon what is essentially what the legacy structure represents, which is really a centralized operating system. So we're quite excited about what we see as a possibility with blockchain, but I think we're still in the first initial phases of developing POCs, developing projects that are going to scale. We've launched a Benji on-chain money market fund. The token is called Benji. It's backed by an on-chain money market fund registered with the SEC in the US already, and we have plans under Project Guardian to launch that in Singapore. So effectively, that is our first test case of the scale and the cost and the speed advantages of what blockchain can deliver over centralized systems. So I think there are ways that if we can prove out the scale of starting with a simple money market fund, that applies then to the wider 40, 50, 60 trillion dollar mutual fund market globally. In effect, right? And I think it's about delivering that atomic real-time settlement someday where it is not T+1 or T+2 settlement, it is really atomic, which is not going to be, I'm not saying that's the case today, but looking forward 5 years out, that would be the advantage of what blockchain can deliver. You can trade any of the cryptos any day of the week, any time of the day, 24/7. That should also be a possibility with where the blockchain decentralized ledger can take us as investors and intermediaries. So I think those are the essential advantages of what blockchain can deliver. Now, coming to some of the investment vehicles. So we do have the two ETFs you mentioned, the EZBC and EZT, that are registered in the US. Those are effectively, they open up the market for institutional investors as well as family offices and other accredited investors to basically invest in an asset class that they either may not have been able to access or may not be licensed to access. So I think it's just about broadening the investor appeal. But we do have other things in the hood as well. We've got SMAs, separately managed accounts of crypto protocols and tokens. We've got crypto blockchain VC funds. So, it's an open asset class at this stage in terms of how we think about the evolution of Web3. And so I would leave it at, just as the internet, back in the 90s was an initial centralized, effectively exchange or centralized mechanism, we're looking now at a world which is decentralized and can hold a lot more possibilities. So we just want to open that up to investors as well as technologists who want to be able to operate here.
Yeah, maybe just for a moment we can crystal ball this a little bit and have a little bit of fun with imagining what does that means for your business if you are able to have that atomic settlement across many other products. That would free up a lot of capital because then there's no pre-funding. You know exactly where your cash positions are and so on. So cutting NAVs could be done in minutes rather than in a 24-hour cycle. Have you guys sort of game planned out where you see what this could mean for what you can do as an institution?
Looking out 5 to 10 years and making projections. I would say we haven't internally, or at least not to my knowledge, don't have a number or a view on the actual amount. But I think at a high level, what we envision is if the advantages of blockchain come to fruition, then you look at the basic level, shareholder servicing costs and the transfer agent, those immediately go away in terms of the expense load on a investor.
Yeah.
So you spread that out across trillions of dollars of mutual fund assets, then it becomes pretty quickly apparent what the potential size could be. So I think the short answer is no, we haven't necessarily put a number to it at this stage, but look, the mutual fund vehicle is now an 80-year plus type of instrument. The ETFs have, and we have a sizable ETF business as well, sitting at currently about 27 billion of assets. It sort of is dwarfed by the 1.6 trillion asset management base that we have. But the point here is, when you introduce a new vehicle and a technology that can make things faster, cheaper, better, I think really it's quite an exciting time in the evolution of the industry. Where things go, our IP, our value add really is the investment expertise and the IP there. And also in terms of managing and distributing the product and maintaining the operational aspects of it. But our role as asset managers will still be to bring the best ideas to the forefront and managing towards client solutions or client needs. So I think as a role as an asset manager, I don't think that changes in a meaningful way in terms of the value that we're delivering to clients.
So I have a question about that investment side, but before I get there, I want to just stay on this one topic around, you've mentioned it, Chetan, a couple times, is separately managed accounts. Now, this is a huge business in the US and some other markets. It's never really gotten off the ground in Asia. The way our products here are distributed primarily through banks is one reason. There's just a lock on that channel. There's also I think people have failed to come up with successful business cases for SMAs here. We've seen Privé Technologies, because they've got an acquisition under the hood, and I've written about this, talked to them about this. They're trying to get this off the ground by combining both product and distribution. But to what extent do you see SMAs? What will unlock this capability in Asia Pacific, particularly ex Japan and Korea? And do you see tokenization as playing, or other technologies playing a key role in enabling that, or is it just a question of figuring out a way to market this?
Yeah, it's a great question. I think the primary two reasons I feel that direct indexing or custom SMAs haven't necessarily taken off as much as the US is one, the tax. For tax reasons, you don't have capital gain taxes in a lot of jurisdictions in Asia. And secondly, ESG or custom value-based portfolios. Not to say there's no interest in ESG, but it is a little bit more muted than what you might see in the US or Europe. So hence, for those two primary reasons, investors haven't necessarily, and primarily, high net worth or affluent investors haven't necessarily sought the kind of advantages that SMAs represent. I would say the third piece is really to what you said earlier. Distribution in most parts of Asia are still controlled by incumbent banks and insurers and intermediaries that may not be fully incentivized to necessarily go the SMA route. So until that regulatory and environment, or the commission-based environment changes, it is, I think it's about marketing and showcasing what is the advantage of an SMA or a direct indexing capability until that really comes to the forefront in Asia as well. I wouldn't say it's, I think there's still a lot of potential for that. But the solutions themselves need to factor in local preferences and local needs. So for example, in Australia, the tax laws and the way the treatment of security selling and buying is treated is quite different than in other parts of the world. So if you're trying to launch direct indexing and SMAs in Australia, you may need to offer a much more tailored type of solution than just cherry picking and lifting up something in the US and delivering it in Australia, for instance.
Yeah. And I have a question on Benji and tokenization, not so much in terms of taking mutual fund products and tokenizing them, but also in Asia, we're seeing this huge uplift in e-commerce, the digital economy, cross-border payments, and tokenization is being positioned as one solution that a lot of people are working on to enable that. You make investment products for clients. Is there a broader play here from an e-commerce or a technology or a payments perspective in terms of what you're looking at?
I think there's a angle here for on the payment side. The stable coins like USDC or Tether or so what Circle is provided is effectively a way to remit money from one jurisdiction to another while maintaining the value at some reasonable level, but without earning the consequent yield that actually the stable coin is backed by.
Right.
Now, if you try to incentivize or at least create a system where that stable coin could be transported within across jurisdictions, but you earn the yield as well, then you've effectively got some mechanism to not only hold an instrument in a wallet that earns a yield, but also use the same instrument to make cross-border payments in a more seamless way. So I do think there's some interesting applications of that. I think the regulatory and the licensing requirements would need to be studied. And I think any cross-border transactions obviously would need to be um, vetted in terms of KYC and knowing your client and making sure that it's not money laundering or any such sort of activity. But that said, I think the stablecoin shouldn't just stop at a proposition of being able to move money from one place to another, but also should provide a yield at the same time in some form, which tokens like Benji can do, even though today it is just an investment option that is registered in those markets.
Okay, thanks, Chetan. So the last area that we haven't really talked about is the actual business of managing portfolios, the process of managing the portfolios.
Yep.
We've talked about technology doing, clearing away a lot of the costs. We've talked about distribution. We've talked about product development. But are you looking at anything? And this is maybe where AI may or may not come in. I guess I'm leading the question a bit, but are you looking at any ways or seeing how your portfolio managers and your analysts are actually using different technologies to be better at what they do or change the way they come up with their decisions and insights?
So I think the first step is asset managers, investment managers, research analysts, risk managers. They're using a lot of different types of data. Hopefully they are. Maybe they're not all of them are. But the first step is really understanding, as you move from structured data and the usual types of data that you are typically exposed to, like financial filings and company reports and annual reports, et cetera. What else can you look at to give you additional insights? And you have to have a way to receive, house, and analyze all that unstructured data or alternative data as it comes in. It's a cottage industry right now. There are players who service this space. But even if you had the ability to receive all that data, how do you then analyze it without building your own servers and building your own, analytic tools?
Mhm.
So it's not just about AI, really. It's really about if I wanted to build out a data warehouse of all different types of data, clean it, make sure it's usable, and then analyze it across a number of different team members. For most asset managers, that is a technology and IT challenge it's not insurmountable, but it is expensive and difficult to do
Yeah.
without setting sort of like a centralized structure in some form. So our company has a few years ago launched on that initiative to create that central data warehouse and bring in different vendors or data analytics providers who can help us analyze unstructured data. And it's at various forms, but I think for the broader asset management industry, this represents an opportunity to, if you want to maintain a competitive edge, you have to sort of look at ways you can leverage technology within the investment management process. I'm reminded of I think it was a penalty shootout it was a penalty shootout between England and in the semifinals of the Euros, where the goalkeeper Pickford had a list of which direction to jump in, depending on who was taking the shot.
Yeah.
And that's a very obviously physical way of doing it. But if you could have signals in your head being sent to your head saying, based on patterns and data analysis, this is which direction you need to be jumping in. That's a huge advantage than 50 years ago when you couldn't have even known what the different patterns might have been possible, right? So that's a simple football-based analogy, but I think then turning to AI, this is where things get even more interesting. And a lot of the applications, and first of all, it's such a broad term, AI. It really comes down to the applications that large language models are being used to analyze. And I think there's some easy picks and quick wins you can have. Like, for example, turning earnings call reports into quickly synthesizable data that you can look at, um, to looking at different trends within the financial reports in a much faster way. But the ultimate objective of AI, I think, is to sort of be a complement to the investment manager and the risk manager within these companies. So I think it's a wait and see at this point as to how these different tools can be helpful. But I don't think any one has come up to the forefront in terms of delivering impact just yet.
No. And how do you, one of the issues with that delivery of impact is, I guess, traditionally with the IT person has a COO on top of them, and she's saying, well, show me the ROI, show me the return on investment, show me the numbers. That can be difficult with some of these technologies, particularly with AI. How do you think about then what, because there is an expense with these things, how do you think about how to lay your bets and what you're trying to get out of it today?
It's I think in terms of laying out the bets, that's it comes down to, are you delivering alpha or not, and how are you really adding value to the investment process, and not just alpha but also on the risk side. Are you delivering any meaningful insights to how the portfolio is being managed? Actually, even on the distribution side, it's about the pre-sale, the post-sale, the uh, analysis that goes on as you're meeting with a client and trying to understand where their portfolios sit and how you can better help them. So there's a lot of different applications, and they all can impact the top line as well as the bottom line, and the performance results. um, I think the first step is really taking that first step and experimenting and being willing to sort of understand and ideate where you can add value. Because until you test and know, and these things are not that simple where you just turn on the switch and the AI model does everything for you. You got to test the models. You got to make sure the data coming in is good. Um, you've got to have a clear crystal process. And I think a lot of that is about the project management of these initiatives within the company, in terms of how the AI applications are actually being utilized. So it's not a straightforward answer as to which area do you focus on and where do you get the ROI. It's really about, let's try a few different things, see if they work, and then take it from there in terms of next steps.
Okay. Well, then, Chetan, I'm grateful for you taking some time to speak with me here on DigFin VOX. One last question just on this theme. Be remiss to not throw in the buzzword of the year, generative AI. How do large language models fit into this? Are they still too hallucinatory and too unstable, or are you finding ways to at least begin to experiment whether or not you can query your internal databases with them, or do something that adds value?
I think there's a lot of different initiatives within the company in terms of how we're using large language models and generative AI. I mean, the most basic ones, as I mentioned, was just you take large filings or earnings calls and transcripts, parse that data into something that is actionable and meaningful for the investment manager. That's a simple tool. Looking at old call reports on the distribution side, figuring out what the client said, where they wanted to be in the next 2, 3 years or 5 years, uh, bringing out those learnings for the salesperson to be able to talk to. So there's some quick and easy, maybe not easy and maybe not quick, but there's some actionable items that both sides can learn from. From there, I think the more difficult aspects are going to be, how do you make this a sustained and prolonged impact on each organization? And at what point does the impact of Gen AI or LLMs, how far does it reach within the human decision making process, right? Because it's good to have aids and crutches, but if they're actually making you like a robot suit, being able to you can control the robot suit, but it's a lot of the functions are enhanced with that suit. Maybe that's a direction where we might eventually reach. But I think I'm reaching too far into the future to be able to prognosticate. At this point, let's take the first easy steps and see how it goes.
Okay, well, that sounds sensible and gives us something to follow up on at some point in the future. You can let us know how, if it's still just a person in a robot suit, or if the robot is actually starting to influence the person. But in the meantime, Chetan Karkhanis from Franklin Templeton, thank you for joining me on DigFin VOX.
Thanks, Jame. Glad to be on DigFin, and have a great day ahead.